Welcome to the Nuts and Bolts of Real Estate Podcast. My name is Joe Bauer, and I'm here with my co-host, Julie Clark. Julie, how you doing today?
What is it, Joe? You couldn't think of a complimentary adjective to throw in front there today?
Yeah. I have it up in front of me, so I read it every single time just in case I have a brain fart. And there it was. Poof.
There you go. No worries. Hey, I'm doing great because we're inching our way, as you probably are excited about, towards snowboard season. But I got a question for you because we like to talk in front of everybody and just whatever. We're thinking about taking the Empire Builder to Whitefish, right? The Amtrak train goes overnight from Seattle to Whitefish, Montana, which has a fun ski area. But my question to you, Joe, is that a foggy? What's the mountain? I keep reading that it might be a little icy and foggy. Is that like a scare tactic, or are we going to have like fogged in vertigo stuff?
So I think what happens, and the reason they say that, is that you hardly ever can see the valley or the lake down below when you're up on the mountain. And when I was there, I've only been there once, so I don't have the stats to back this up. But when I was there the one time, we got a beautiful view from the top. So it does happen. And I do have a fellow entrepreneur that actually moved to Whitefish because it is so good for, skiing in the winter and, mountain biking and such in the summer. So.
All right. Because that was causing a slight pause for me. I'm like, are we going to get fogged in and get I hate that. I don't know if you've probably all been in it if you're a big snow or ski board, a ski or snowboarder, where you get almost like vertigo, right? Where you can't even see in front of your face. And I got two little girls with me, so didn't want to do that. But I think we're just going to go for it.
I think you should.
Yeah. So speaking of going for it, a lot of you guys, this is my transition. A lot of you guys are going for it on your short-term rentals. And you're making some serious bank. And the thing that nobody thinks about is you got to pay tax. So today we have our friend and our go-to real estate tax strategist, Natalie Kolodij. I got to figure out how to say it because it's not spelled how you say it. Natalie, what's up? She's back with us to advise us all here about the tax topic with a huge planning opportunity that's related to short-term rentals. Because a lot of tax professionals, according to Natalie, have no idea about this. And it means that you might be paying too much tax on your short-term rental income. So welcome back to the show, Natalie.
Thank you guys for having me back. I'm happy to be here.
Yeah, you've kind of turned into slight celebrity since we have had you on since the beginning,
Yeah, I'm just one of the few accountants who aren't so painfully shy that they're willing to talk to the public. So it's going really well.
Yeah. So you guys, if you haven't checked out Natalie's shows and episodes on Bigger Pockets, we sort of have a Bigger Pockets celebrity with us today. And you know what? She's right. She knows how to talk straight at you. So we're going to get into that today here. And hopefully it's only November 2nd here. You guys are probably hearing this in mid-November. And we're going to try and save you guys some money for your taxes this year. So let's get into it, Joe, and let's kick it off.
Yeah. First off, if you guys want to get Natalie's whole story, head over to seattleinvestorsclub.com/119 for our previous podcast. But this time around, Natalie, if you could just share your business background, that would be awesome.
Yeah, so I have a degree in accounting and tax, and I got into tax and real estate at the same time when I got out of college. And so I just ended up kind of combining the two and becoming really specialized. And now I actually own short-term rentals, and I work in the tax realm exclusively with real estate investors. So that's what we've got going on this side.
Awesome sauce. Well, let's jump into it. What the heck's going on with short-term rental income that's keeping you up at night?
Yeah. I always tell people that as soon as I hear from a new client that they've gone to kind of a general accountant or, they've had short-term rentals for years, I know there's probably going to be something wrong. And it's a newer type of investing. And so tax-wise, there's just less guidance on it. There's been less cases. There's kind of less people who have really dove into it, and there's not as many just like tax education courses and things like that available. So I think a lot of tax people just don't realize that there is any difference or kind of any big planning points here. But there's a few things that I see regularly that are kind of done incorrectly with short-term rentals, or where they're just sort of missing something that could be done better. So with short-term rentals, one of the kind of most confusing things for people is if it's a rental or if it's like a business, because you think of like a hotel, and that is more of a business. That would get reported on Schedule C of your tax return, which would make it a regular business where you would pay self-employment taxes, because there's kind of a different set of services you're doing. You're not just renting, you're doing daily cleaning, you're offering meals on site. So it's kind of more of an active, ordinary business. And so the biggest mistake that we see is a lot of tax professionals will by default take those short-term rentals, and instead of leaving it on Schedule E, which is where you report rental income, they move it over to Schedule C as a business. And because of that, any profit you make on it, if you have taxable income at the end of the year, it's being subject to self-employment tax.
Boo.
Yeah. So that's the like biggest red flag thing is if you have a short-term rental, if you see it on Schedule C of your taxes, talk to your tax person or get a second opinion, because there's a really good chance that it shouldn't be there.
Yikes. That's so how far back, if this has been going on, first of all, how much is self-employment tax? I don't even know if that's an easy question, but how much?
About 15.3%. What it is normally like your W-2 job, all of those small taxes that come out, the FICA, Medicare, Social Security. Normally you're paying for half of that and your employer's paying half. And when you're self-employed, you're both parts and you pay all of it. And so anything reported on Schedule C pretty much is going to be subject to that self-employment tax.
Right. So is that a reason why I'm dork? I was actually an accounting major, but I've forgotten everything that I've ever learned. So I kind of know some stuff, but I don't. So I'm going to ask you some weird questions today. Does that mean that anyone who has short-term rentals, well, first of all, I guess what we're saying is get it off Schedule C and make sure it gets on Schedule E, right?
So what I tell people is just kind of a multi-part test, but I do only real estate, right? So I see a lot of short-term rentals and I've only had one or two ever that should be on Schedule C. So if it's there, question it, because the only time it should be over there and be paying that extra tax is if you're doing two specific things. The first test, like the first thing to consider, is if the average length of stay, like the amount of time your guest stays, is under 7 days. So if it's really short term versus like if you do short term like traveling nurses or like longer stays. So if your average stay is under 7 days, that's sort of the first test. But the second test that also has to be met for it to be on Schedule C is that you also have to provide substantial services. And very few people do. And to the IRS, that is literally, those are those different services that would set apart a rental from like a hotel. So that's sort of what I tell people to keep in mind. So substantial services would be if instead of cleaning only in between stays, between guests, if you offer daily room service, someone can come clean every day, turn down your beds. If instead of just offering a stocked kitchen with supplies, you have a restaurant on site and offer free meal service, like in-house or in-room delivery, or some, like, especially in Europe, some Airbnbs will include your meals. So things like that are what they would call substantial services. So you're sort of running a business within your rental. If you're not doing those things, it is not subject to self-employment tax and it shouldn't be on Schedule C.
Wow. What if you had like a farm, like some sort of farm? I know somebody that does this and they have like a farm on the property, maybe that people can maybe grow their own stuff. Is that going to be confusing for tax purposes?
It would depend. It would be kind of a facts and circumstances. If part of your stay, like as part of what you paid to stay there, included like you got to go pick your own vegetables and then someone cooked it into your breakfast for you and you got to take home a baby chicken, then you're probably a business. But if like you're just on a farm and it's nice, I would stay there. I would stay there all the time. If
Don't offer baby chickens, everybody. That's what we're talking about here, Joe. That's a timestamp. Don't offer baby chickens. That's good.
This is fact. But if it was like because you stayed there, they give you a basket of eggs for each stay, that's probably not a substantial service. So it's kind of this facts and circumstances. But what I tell people is just sort of think about what you get when you stay at a nice hotel versus what you would get just at a normal rental. It's just that instead of a year lease, you're renting it for 7 days or 4 days.
Right. So when you say that Schedule C, bad self-employment tax, okay? You're saying that when it goes on Schedule C, bad, it has to hit, I'm looking at my notes here. I hope you guys are all taking notes, or at least hit the subscribe button so you get all this information. But the average length of stay needs to be under 7 days, and they must provide substantial services. Is it both or one or the other?
You have to be doing both. And that's why so few really actually belong there. But a lot of tax professionals, as soon as I've just seen it put there multiple times because they just think it's different than normal rentals. And by default, they were putting it there. So that's why I was telling you this was sort of my like soapbox right now. And it's because I keep getting returns with it in the wrong place. And then I keep going into tax Facebook groups and like yelling at people.
Yeah. We want to yell at people. We like
the gospel of scheduling.
We want to yell at you guys. So everybody needs to go look at their previous tax returns and see what's on their Schedule C versus their Schedule E. You want your short-term rentals showing up on your Schedule E. And what if everybody that's listening is like, oh, crap. That ain't me.
Yeah, you probably want to amend those returns and you can get a refund on an amendment back 3 years. But if you see that difference, I always tell people, talk to your tax person first. There could be a reason it got put there. Maybe you are doing services that do qualify, but it's always worth asking first. If you get sort of if they can't give you a literal reason, talk to a second person and get a second opinion on it, and find out kind of the best way to correct it and fix it going forward.
Well, there's a question that you'd think with all the short-term rental craze, a good CPA or a tax professional, tax preparer, I guess would say that they would know this off the top of their head because it's such a big thing going on.
And I think part of the problem is there's sort of this weird overlap with when a rental is a business because there are different tax code sections between what determines passive activities and non-passive and what determines a business or not a business. So people, I think, get confused with when one sort of overrides the other, or like if a business decides the form versus passive or non-passive. So that's, I think, where tax professionals have a little bit of a disconnect. But all you guys need to know for the general public is if it's on C, question it, kind of go from there.
Right.
Sort of the step
well, and then know what, for example, what you don't want to do. You don't want to do daily cleaning. And do you only need to do one substantial service, or, you know what I mean? Like, or is I'm getting into the nitty gritty here. So if I had my average length of stay under 7 days and I just did one thing like daily cleaning, that boom.
Might move you over. Yeah. Because that's how it's worded. And to figure that average length of stay too, in case people aren't sure what they're going to look at, if you have, say it's been rented for 300 days of the year and you know that you had 100 guests, your average length, you'll just divide those 300 days by how many individual bookings for that 3-day average. So you're just going to take your total number of days it was rented, divide it by how many stays there were, and that'll give you your average stay. Because some might be a day and some might be a month, and you get to figure it out. Yeah.
Right. Good one. That's a good question, right? So, okay. Don't feed people. Don't clean up daily.
Yeah. They just have to be independent adults living in your building. You're good. Yeah. Don't do too much else. Yeah.
That is very, very, very great advice. This is like last time where you told everybody to go check on their rental income, that it was getting booked correctly. If you guys haven't listened to Natalie's previous podcast with us, like Joe just gave you, and that's in the notes below. You need to go listen to that one because you might be screwing up there too. That was a topic that we covered, on if your rental income, not your short-term rental, but your regular rental income was getting reported correctly. And she give you go look at this page in this section. So that's why she's our go-to tax strategist, guys, because she speaks very plainly and clearly. What else? Do we need to know anything else that's going on about that? That's actually a great question. If you've gotten into the short-term rental business, when you are going to hire a tax professional, this could be, you need to interview these people, guys. You need to listen to Natalie's first podcast, listen to this one, write down some notes, because there's probably 3 or 4 questions you could ask off the top that you're going to know right away whether you should hire that person as your tax professional or not. Wouldn't you say, Natalie?
Yeah, that's typically what I tell people is there's kind of very specific, and this is what's tricky is how are you, someone who's not a tax expert, supposed to be able to vet a tax to really know what they're doing. But there's a handful of things, like the Airbnb one is kind of a big one. If someone says they specialize in real estate, they should know this. Someone who's a general accountant may or may not. Right. So there's just sort of a list of weird things to ask if rentals qualify for the 199A deduction is sort of my other vet them out question.
What does that mean?
199A or QBI came out a couple of years ago, and it was a 20% off credit, essentially 20% off deduction on any business income. So again, it's that overlap of when is your rental a business? So if they tell you flat out that they don't qualify, that most rentals won't, or that they only qualify if they meet a safe harbor that the IRS released, it's a little questionable because most rentals do qualify because the definition of a business is just a continuous ongoing effort to basically produce profit is sort of how it's defined in the tax code. So that's rentals for most people. The only time it wouldn't would be, you have some people where they inherited it and they've ignored it and they've never raised rents. And that's not really a business. But if you're buying things to try to rent for profit, it likely qualifies. So those are 2 good, vet out your accountant questions.
What about the question of why self-employment isn't, let's talk the whole SCorp thing. Does that come into play? Is there any better entity at some point that you should use if you're having rentals, or is there a difference between short-term rentals and rentals on entity type best for tax purposes?
No. And even if it is paying self-employment tax, this is sort of the other hill I will die on, is that don't put your rentals of any kind in an SCorp. And this is where people get mixed up because for wholesaling, it's great. For active income flipping, it's great. But for any kind of rental, you don't want to hold something in an SCorp for a long time that's going to go up in value because of the way their tax laws work. If you distribute something, if you take something out of an SCorp, even if you're just transferring it to yourself, that's a taxable event at fair market value. So if you want to put it back into your name to get a better loan on it or refinance, you're going to pay tax on selling yourself your own rental. So don't put them in SCorps, please. Please.
Oh, well, let's talk some more about that. So we have, I want to make sure we close the book on our short-term rental. Any other short-term rental advice? We'll stick on that for a second.
Yeah. So there's actually kind of a second big part that gets missed, maybe even more. So like I mentioned at the beginning, how most rentals are passive, right? We've, I think, talked about that, how they're passive income and passive losses. So normally any losses from rentals are subject to these passive loss rules, where if your income is above 100,000, you might not be able to deduct those losses in the year. If it's under that, you can typically deduct up to $25,000 a year of passive losses. But once you're over that amount, they carry forward to the next year. You can't always write them off. So rentals can, by definition, short-term rentals can be non-passive if they have that average stay of less than 7 days. And the other part to this, and this kind of goes for the Schedule C thing too, but they have to have that under 7-day time frame. And as long as you're materially participating, and there's kind of 7 different rules for that. And I can link to them or give you that link to put it in the show notes maybe, so people can kind of walk through the tests.
Please.
But it's not super hard to meet. As long as if you're not outsourcing management and you're spending 100 hours a year on the property, you count. If you're spending at least 500 hours a year, even if you do have property management, it still counts. So maybe they just handle like repairs and on-site things, but you do all the bookings, you schedule contractors, you do handle that part. Anyway, so there's 7 tests. I'll send you guys the link. But if you're materially participating and your average stay is less than those 7 days, then that activity is technically not passive.
Yikes.
That it should still stay on Schedule E. It still lives there. But the good part is if you can generate losses, which you can if, and a lot of short-term rentals cash flow well, so it's harder. But if you do a cost segregation or look at some other kind of strategies to create a loss, even if your income is over that $150,000 mark, you can still deduct those losses potentially. So this is kind of the planning point, is that for a lot of people whose income caps out, if you can qualify for this sort of in between where your short-term rentals are non-passive, we can generate losses that you can deduct. You're not subject to those income caps anymore.
You said if you can qualify where your short-term rentals are non-passive.
Correct.
Then you, if your income's over 100, you still might have a shot at writing off the deductions.
Yeah, exactly.
I don't know why in my head that seems counterintuitive.
Yeah, a little bit. It's just because passive losses are so tightly limited by that income limit. So if we can take it out of that category, then now we're not subject to that income cutoff.
So we're saying we don't want our short-term rentals to be passive. We want them to be non-passive?
In theory, right? So like with tax, everything depends. So generally, yes, right? If we know that we can do a cost segregation and when you do a cost segregation, you basically take the value of the house and break it into little components, an engineer does. So instead of saying, I get to write my house off over 27 years, we get to say, I have a heating system and windows and flooring, and those are all 7-year items. So we get to write off more at once. So if we do that and we create this $10,000 loss in the first few years, now you can write that off every year, instead of if it was passive and your income was $200,000, that loss would just be stuck in limbo. It would just be stuck in the property until you sold it or until you had passive income to use the passive loss against.
Super, super planning.
Yeah, exactly. So that's why you have to kind of think about this with foresight, because you might want it to stay passive if you have long-term rentals with a bunch of passive losses and you need passive income to offset it. But so there's kind of this planning point where you should have someone you're working with to look at this and see if, because like we talked about earlier, like 7 days, the average stay time is something you can sort of manipulate if you encourage longer stays with a discount or sort of plan your Airbnb or your short-term rental to really fall one way or the other. You can sort of work this into your tax planning strategy. Right.
That is, and it can change annually based on your income, right? So we always talk about Dr. Tax Pro. That's like you go for your 6-month checkup. Everybody should be going for their 6-month checkup to check in on their situation for the current year and the future years to adjust some of your tax stuff, right? Like, to me, you know what I mean? That like tax planning, right? That's the word, tax planning. You need a plan.
Yeah, absolutely. And that's kind of the difference with just tax preparation versus tax planning, is they're not the same service.
Right.
So you hear people say like, my CPA or my accountant never tells me anything. They never suggest stuff. All I do is meet with them in January. Like, I don't get it. I pay them $199 a year. Why don't they do this? Well, it's because you pay them. It's like if you went to, Jiffy Lube for an oil change and you were mad that they didn't fully detail your car or fully rebuild your engine. Like, those are different things. You paid for this very specific limited service. They're going to do that and move on. If you're paying for tax planning or working with a tax strategist, you're going to work with someone who's going to spend time with you during the year, being proactive and making suggestions so that you can save money and they're not just taking your information and reporting it. So there's different things. Yeah.
So you think you're saving money by spending $199, but actually it's costing you a lot more money because you're paying higher tax that you shouldn't be paying.
Yeah.
Right?
And the other trade-off that can be even worse, and I'm actually about to put out an ebook to sort of try to curb this, is because so many, I think, new investors skip on a tax person because people will say, oh, you only have 1 or 2 rentals, just do it yourself till you have more. And I get it. If you're only like cash flowing a couple $100 a month, you can't spend your whole like I wouldn't tell you to spend all of your profit on a tax professional. But the problem with rentals is if they're set up wrong in the beginning, with the depreciation, they stay wrong and they have to get fixed at some point. So it ends up costing a lot of people more, because it will always cost you more to go backwards to fix something than it would to do it right the first time.
Right.
So
what does that mean that they're set up wrong from the beginning? What do you mean?
So when you depreciate a rental property, so when you get to depreciate it, it basically, the IRS says if you're using any kind of an asset for a business purpose, they assign it a life. So they say this should be able to like exist and function and make you money for so many years. With properties, with houses, that's 27 and a half years. Why? I'm not sure. They really just had to throw the half year in. That's probably what really matters, but that's the amount of time we get to use. So when you set up a property, when you buy a house, if you buy a house for $100,000, we're going to ignore like closing costs and all that to keep it simple. You get to break it out into a value of your building versus your land, because you can't depreciate land. It doesn't wear out. It just is the earth. It's here forever. But then say your building is 80% of that cost is what we figure out because of the appraisal or the county assessor. There's a few ways to figure that. So we now have an $80,000 expense and we get to write that off over those 27 and a half years. So every year on your taxes, you get to write off 1/27th of that. And that's why a lot of people will have a loss on their tax return for their rentals, even if it makes money, because you didn't write a check to get that depreciation each year. It wasn't a cash outflow, but it's something we're allowed to write off on taxes. So you can actually be profitable and have cash in the bank at the end of the year, and then write off that portion of the house's value, and then on your taxes have a negative amount. And so that's sort of where we want to land. So of year one, something we see a lot is like not separating out that land value. So you're deducting too much. Or something we see is people who will, like if they're doing a BRRRR, especially if it's like with delayed financing, so sort of your rehab costs are rolled into your purchase price. What I've seen is that whole amount gets split between building and land, where really your rehab cost should be fully able to be depreciated. Those don't have a land value. That's all new construction. So if you make those mistakes the first year and put it on your return, those same numbers are what you have to use for the life of the rental, unless it's corrected. So if you set it up wrong that first year, the amounts you're deducting every year will be wrong.
Yes. Geez, see guys, these are details. So it adds up. It adds up. No doubt about that. Hey guys, it's Julie here with a quick break from the show to discuss an opportunity some of you may have interest in, which is to work more closely with me. On almost a daily basis, I get calls from investors and brokers, both new and experienced, asking me for guidance or advice. I love helping you guys out, and it keeps me on my toes too. So with that said, I wanted to let you know that I have a private broker coaching community called the VIP Education Community. And the best part is that it's 100% free. That's right, it's free to join. So whether you're a traditional broker or a broker investor, my VIP education community offers personalized one-on-one coaching from not just me, but also from my experienced broker friends with expertise in all disciplines of real estate and real estate investing. We'll teach and share our modern marketing strategies, our tech and lead generation resources, plus teach you how to identify or offer up opportunities for yourself or for your clients using techniques such as seller financing, lease options, land entitlement deals, BRRRR investing, flipping, multifamily or commercial coaching, whatever you like. We've got it all covered for you. The future of real estate is changing fast, and to stay in the game, it's time to learn about all the options you can offer your buyer and seller clients, as well as, if you want, learn how to use those skills to grow your own real estate portfolio. If you'd like more details about joining my VIP education community, reach out to me at julie@seattleinvestorsclub.com or text me at 206-910-2985 or just send me a Facebook message. My new favorite phrase is community equals confidence. So let's navigate the future of real estate together. Now, back to the show. I want to go back to the entity thing for a minute. Is there a way for you to say, like, if you just have regular old single family rentals, go like this. If you have all short-term rentals, go like this. Or you have a mix of the two, do it like this on entity formation. Now, this is from a tax standpoint, not a legal standpoint, right? So again, guys, you need a team of people here. You need a legal professional and tax professional to be guiding you. And in my case, I like to have a financial advisor as well, who I have found that my personal financial advisor, if you guys need a great one over here, I have such the best guy. He has called out my CPA on stuff that he's not doing right to maximize my retirement accounts and stuff like that. So you need a village here, people. But is there anything we can cover on the entities for different types of investors?
Yeah. So from a tax point of view, when it comes to rentals, whether they're short or long-term, don't put them in an SCorp is sort of your first rule. Just don't put them in there. If your accountant suggests putting them in there, like I said, it's very unlikely that you're even subject to that self-employment tax to begin with. So question that first. And then also, even if you do have it, I still don't think the offset would be worth it for the risk of having your property trapped in your SCorp. Like you would have to know 100% that you never wanted to move it out of there for any reason. So that's really the only tax impact issue. Then whether it's in your personal name or a single member LLC or a multi-member in a partnership, there's no tax difference. So there's nothing that you can or can't deduct one way or the other. There's really no tax savings point to that. It's just from an entity, a legal protection point of view is why they get set up that way. And so I always recommend talking to an attorney. And on kind of my soapboxes, I'll just add the little note too, that if you're brand new and you're being sold like a $15,000 entity structuring package for your one rental property, please talk to someone else first, like talk to another attorney. There's some big name firms out there and they tend to treat everyone the same, regardless of if you have $1 billion worth of real estate across 40 states, or if you have one $60,000 property in Georgia, and they will still sell you the same thing. And I don't want to see people, it makes me crazy to see people like where it's going to take you 25 years to recoup that investment on your property. So if you get sold that, like get another opinion first before you feel like you have to.
Right. No doubt on that. Oh man, all good stuff. My brain goes wild on this kind of stuff. It's good nerd. It's good nerd. We're doing some good nerd today.
Good nerding, yeah.
Good nerding today. Anything else that you want to cover that is, keeping you up at night or anything like that you want to share while we have you today? We have you captured. We have you trapped with us today. So,
I mean, if you're going to give me a camera and say rant about tax things, I can do this every week, Julie.
Yeah. Oh man, I could do that. Now that you said that, I will be calling you more often for sure. Absolutely.
Please stop bringing that mean tax lady here. She just keeps yelling at everyone.
No way. We love it.
Yeah, so those are kind of the big things. Like I said, the reason I'm writing just a short ebook is to sort of give people, like we talked about, just a walkthrough of look at your return for these 10 specific things, because they're the 10 things I see incorrect the most. And so, like I said, the short-term rental thing, the entities, there's just sort of a handful of things that I think a lot of accountants miss or don't know the importance of. I don't remember if we chatted about this last time, but another thing that you see a lot that won't mess up your taxes, but can mess up your lending is reporting the fair rental days for your properties. A lot of accountants, it's on Schedule E, it just says fair rental days. And by default, a lot of people just put in 365 or they leave it blank. And lenders look at that. And I've had more than one lender tell me that it kind of adds a further underwriting step if that doesn't check out.
What does that mean, fair rental days?
So a rental is in service or available for rent, or kind of the definition of in service is if it's ready and available for rent. So not necessarily occupied, but just either you're actively marketing it or you could be, it's listed, you're in between tenants because you're just doing touch-up paint, stuff like that. Those are all fair days. Like it is still functioning as a rental, even if there's not literally someone living in it. And so what lenders will look at is they'll look at that and then how much money you made. And so what we'll see that'll be wrong a lot is like someone will just get a property. So it'll really only have like 30 or 60 fair rental days. So it only has like $1,000 of income and then a bunch of expenses. And so if it looks like it was in service and has 365 for rental days, the lender looks at it and they're like, this property is garbage. Like you made $1,000 in a whole year.
Right.
So having that match up to the amount of time it was actually available for rent can save you a headache in underwriting. And especially right now where everything I feel like loans right now are just as crazy as kind of the tax world because things keep changing. So you don't want to get caught up on another 3-day kind of verification step.
Right. Speaking of lending, that's a big topic. I wish I had my buddy Albert Bowie on here with me today. I don't know if you know Albert, but he's kind of my ninja. He kind of crosses over tax and lender nerd, which is awesome. But for people who, they change entities or quick claim their deeds over for lending purposes, is there a topic in there to cover? Like, because sometimes you can't get a loan in your entity, so you deed it over to yourself, or you buy it in your name and then you quick claim it over to your entity. Let's cover that for a second.
Yeah. So the thing we see incorrect there a lot, or that kind of comes up, and I've heard this kind of suggested wrong, and I'm not an attorney, so double check with an attorney, but this is a lot of people want an LLC to protect their rentals, but then they never put the rental in the LLC. And from everything I've been told by attorneys, it likely still won't protect you. So even if their lease is with your LLC, but you're keeping literally the title to the rental in your name, even if that's who it has the tenant has the lease agreement with is this LLC, the underlying cause of the lawsuit is still the asset. So that still would probably cause you a headache. So typically the biggest hang up with entities is people not using them correctly, kind of like, or if you create an LLC, even if you put your property into it, but then it doesn't have a dedicated bank account, it doesn't have dedicated books. If you're ever in a lawsuit, you've pierced that corporate veil, you've intermixed business and personal. So it's kind of people setting them up, but then not following through on all the like annoying, not fun, sexy, can't brag on the internet parts of it. Like they've got all this back end stuff that's not as exciting as saying like, I opened 4 LLCs this month. Like, okay, that's cool. But like, you've now got to do sort of the work with it. And then the other thing we see is kind of that same thing, but it's much worse if it's like a partnership. So if 2 people create an LLC, run all the business income and expense through it, and the asset isn't in there, because with a partnership, we report a balance sheet. You have to report the assets owned by the entity. So now we've got this issue where technically the legal owners of this building are you and your brother, but you put all of the income and expense and reported like the Airbnb 1099 got sent to the tax number of this partnership instead. So we've got this reporting mismatch. So those are kind of the biggest things. And that's where I would tell people to sort of slow down when you're new at investing and talk to professionals first, and talk to all of them first, like meet with your attorney and your tax professional and kind of figure out what you actually need for an entity. Don't just hop on Facebook, ask a bunch of people, and someone says to you, oh, my LLC saved me $40 or whatever it did. And so then you do the exact same thing, because everyone's situation is different. So sort of take a step back and like make sure you're actually setting it up in a way that's going to do what you need it to do. That's not going to cost you more money than save you. That's going to actually protect you. So don't just dive headfirst into LLCs.
Right. And I think the key thing here to remember needs to be highlighted is that everybody's different. Everybody's situation is different. And unless somebody's assessing what your entire situation is, not only your current situation, but what you're planning for the next year, right? Or what your longer term goals are, right? That's called tax planning. And people will drop 10 grand to get coached by somebody, but they won't spend 1,500 to get, a consultation or whatever, or 2,500, whatever the number is. Like Natalie said, you don't need to spend 10, 15,000 to do that. You might spend 2,500 or something to do that. And that is almost more important than the coaching that you're going to get, because you don't want to go backwards once you start having some successes because you didn't tax plan correctly, right? Big thing there.
Absolutely.
So, wow. Yeah. So there is no tax issue stuff when somebody buys in one entity, quick claims it to another, and then for lending gets a loan and then puts it back type of stuff.
Could be. It depends, especially on the state level. Like you might have transfer taxes and things like that. That'll come into play. Typically people do it pretty quickly. So if, during the year it was out and back in, especially with a single member LLC, there shouldn't be too many issues, but it's always a good idea to talk to your accountant ahead of time. This is why, for as like preached about as LLCs are in the real estate community, for some people, they're not always a good fit because of things like this. So good insurance or another option might work better. So run it past your accountant and your attorney ahead of time to make sure you're not going to trigger something or create a tax situation or something like that before you do it. Right.
Is there any, if somebody has a single member LLC, I remember back in the day, I did a condo conversion. Woo, those can be scary these days for lawsuits and stuff like that, on a 27 unit building I did in West Seattle. And I remember being worried after the fact because you get sued when you do condo conversions by the homeowners association, because there's attorneys that they wait for that to about to expire and sue the developer for all kinds of stuff. It's just part of the gig, right? Doesn't mean you can't negotiate your way out of it, but it'll happen. And I had a single member LLC, and I remember freaking out whether they used my personal social security number on that or a separate tax ID number. Is there, with a single, is there any, it's kind of maybe more of a legal question. What should a single member LLC have for a tax ID number?
It should always have its own EIN number. So when you set it up, make sure you get that. But at the end of the day, like I say, talk to an attorney.
Yeah.
But I would say 80% of LLCs I see, or their books for them, aren't kept well enough that it really keeps everything fully separate anyway. So I think for a lot of people, it's like a security blanket. It makes them kind of feel warm and fuzzy, but it might not actually do much. So either like do it and do it right and kind of take the right steps, or just skip it.
I guess that's a legal topic. Yeah. A legal topic would be going over the basics of how to keep everything separate. I guess that's a legal topic that we could cover. Okay. Anything, what else you got? You got anything else that's juicy that we need to know about?
I think those are the big things. Like I mentioned to you kind of, we were chatting earlier. Right now, they just mentioned this past year, unemployment income they changed it kind of after they started doing it. They changed a lot of things this last year after like tax season was in swing, but they made up to $10,000 of it non-taxable. So if people had already filed their tax returns at that point and paid tax on it, they're currently going back through and reprocessing that and issuing refunds. So if you had unemployment in the past years and filed really early in the season, double check on that. Just check your mail or your bank account. And on the same kind of topic of the IRS going back through and processing those, I will say just try to be a little patient with your tax professionals right now. The IRS is 8 months behind on opening mail and processing anything we mail them, and they're answering less than 3% of phone calls. But yes, they 100% are still sending people notices, and I'm really sorry. It's terrible because they keep sending them and we can't get anyone to fix it.
Right.
So just be patient. There's no one at the IRS right now. So it's kind of a head up against the wall thing, and just be aware too that if you mail in anything like an address update or anything to the IRS, they probably won't have it before you even thought, like if you sent it today, they won't have it before you file your taxes this year kind of thing. So everything is just very behind with that.
What do? You just go with it.
Cry. Yeah. You just have to like call, try to get a hold of someone, see if there's an alternate where you can fax it in. But it's just that they have very, very few people working. And with all of the tax changes the past few years from COVID, every time they'd release like the stimulus checks, it was always a tax change. So there's been all these updates and all these kind of new laws that come into play, and it's just, they're stretched so thin. There's no one working on being helped.
What about the child tax credit? People are getting checks, I think, for $600 a pop.
Yeah. And they're extending those, but they keep changing it. So it's kind of one of those.
Taxable?
I don't believe so, but I would have to double check offhand.
Okay. No worries on that. Wow. Good stuff, guys. There's a lot to think about there. You're going to have to listen to this one more than once, I think. So the point is, action steps after this podcast is over. Oh, wait, there is one other question I had for you before I do that is, how about what are you forecasting in regards to any 1031 or any trouble with new policies of taking away tax deferrals or 1031s or stuff like that all real estate, people that own real estate and have grown their wealth and want to pass that on generationally? Do we need to be worried, or what's your prognosis on that?
What I tell people is don't worry till there is something, like, especially with the last, like when the CARES Act, I think is where it was, came out, they were trying to move like several things, like several big tax changes. And it was like very likely. And then by the time the final version came up, several of those things were gone.
Right.
So, and people are still confused about them. Like people still think some of that passed kind of thing. So I wouldn't dig too deep until it's like on the final step of becoming actual law. But I would be leery with 1031s because they've been like one of the big, during the last administration, one of the big tax overhauls got rid of 1031s for everything else except real estate. And it kind of sucks because we got them originally for farmers. It was how farmers could like trade out equipment to cover different like growing seasons when they would switch crops. And so they can't just swap out farm equipment tax free anymore when they have to like sell and buy different stuff. And so they got rid of it for everything except real estate already. So I feel like it's been this sort of thing on both sides of the political parties where they've sort of looked at getting rid of it or limiting it, or so just be leery of it. Like don't have that be your only kind of exit strategy or your only plan. But it's hard. Lots of rich lawmakers own real estate. So it's hard to say if it'll ever actually go away because it's not in their benefit. But
is there anything, like, we're getting to the point in the year where I've got some transactions and I actually have a big apartment building feasibility I'm running to after this. And is there any sense, or if you were advising anybody about whether they should, if they were going to sell, whether they should sell by December 31st or have it be a January or, have it be a 2022 date? Do you have any sense that it matters or anything at this point?
Not at this point. I haven't seen anything that's going to very specifically come into play with that. Mm-hmm. There's a few weird things that are on the agenda, but like I said, every big one we've had, so like pretty in recent years, what's in the first few drafts of the bill and what they sort of push through at the 10th hour when they're done fighting is like, they get rid of most of the important things. So it's like, it's hard to say until anything actually gets a little further.
So in our state, everybody, I don't know, is this a federal or is it a state thing that everybody's rushing related to long-term healthcare tax that we have? Maybe that's just a state thing here.
I think it might be a state thing because it's not a federal penalty anymore.
Okay. So if you guys don't already have long-term healthcare insurance, I think you just got a small spanking on your taxes in Washington state. So we won't, I think it's like a 0.58% per $100 earned or something like that. But check with your tax professionals on that. Most of you, if you're in the Seattle or Washington state, you should already know this, but okay. Well, geez. Anything else? How's your dog? Do you still have, remember that we don't want to give it away because for those of you who did not listen to our first podcast with Natalie, something extremely funny happened. And we actually, it was awesomely funny. I think it happened at about, if I recall, about 26 minutes in. And so we want you guys to go jump on that podcast that Joe has dropped below, and it's a good one. So you should listen to the whole thing, but make sure you get at least 26 minutes in. And then I always want you to drop below if you know what it is, right? Or if you have any experience at Whitefish Mountain with the fog, you can drop me some notes below on that if you're a skier or snowboarder. But once again, we could talk to you for endless hours. I have a feasibility I got to get to today. But now that you have let the cat out of the bag that you could talk for hours, maybe we will record little more sound bites with you. That can be just like 15 minutes or something, or 10 minutes. We might, tax tips. If you're like, God dang it, this is bothering me. That's your signal to call Julie and Joe, because we want to record with you on that.
Got a microphone and I'm angry, you guys.
Yeah. Whenever you're getting anxiety, call us. We want to know what it's about, right?
Sounds good.
Awesome stuff, guys. And if you're ever bored on a Thursday Pacific time, 11:30 to 12:30, maybe even once a quarter, jump in with us or whenever you feel like it. We have a roundtable weekly meetup. You guys, it's awesome. We've been doing this now for a couple of years, and I keep asking myself, what the hell are we going to talk about? Because it's an open table topic every week from 11:30 to 12:30. And to this day, I am amazed at how awesome it is on the topics that we talk about, that are just people come ask their questions, or we use collective genius to answer people's problems or challenges on all, whatever, real estate. We have such a great network of people and resources that if we don't know the answer, we can definitely point you in the right direction. So I like to call it Just Ask Julie, but we do it every Thursday from 11:30 to 12:30. All you have to do is go to meetup.com to Seattle Investors Club and grab the link. It's just a Zoom link. It doesn't change. So copy and paste it, everyone, into your calendar so you know to show up and join the conversation. And for those of you that are members of Seattle Investors Club, that is recorded for you. If you pay the $220 annual membership, you can listen to those after. And Joe and I are trying to work towards time stamping those topics and letting you guys know what the topics are we talk about every week. But otherwise, it's free to show up. And we might be able to twist somebody's arm like Natalie's to show up every once in a while. So you never know who's going to be there. But come join the conversation, guys. You're missing out. You are missing out. All right. What else, Joe? We want them to subscribe to our YouTube channel. If you like this content, if you thought we did a good job with Natalie today, please, Joe, you take it from here. I don't know what to say.
Yeah, absolutely. We'd love it if you subscribe, give us the big thumbs up, smash the thumbs up or like button. And if you want the show notes, they're either down below in the comments or in the notes section, or you can go to our website at seattleinvestorsclub.com/153. And then I'll have the show notes, a link to Natalie's previous podcast, and everything else that you desire.
All right. Good stuff. All right, guys. Well, that's all we got today. Again, Natalie, we treasure you. You are our secret ninja. We value you highly, and we think you are one of the most, I would say, because I'm a nerd, I like nerd, and you are one of my favorite nerds, right? I consider myself a nerd. So knuckles to you, and we love it every time you come visit us. So Joe, stay safe out there, and we'll catch you guys all next time. Over and out.
Thanks for listening to the Seattle Investors Club podcast. If you have questions that you'd like to have answered on the show, shoot us an email at info@seattleinvestorsclub.com. Now go out, take that action, and build that real estate business. Thanks for listening.